Hi, all. Welcome to the latest edition of Free Float. I am Sham and I have Kishan with me.
Yeah, yeah. Hi,
Uh,
everyone.
Hi. We'll be discussing, something that is a total bheja fry for me, which is why is the market going up when we are in the middle of a pandemic? Sales are down almost 50% for everybody, and there's like curfew being announced every Sunday in Bangalore. I don't know, different areas have different things, but we can't step out of our homes without a mask. We have to maintain 6 feet of distance from everybody. We can't go to the gym. We can't exercise as usual. We can't go to the bank. So we have all these things that we cannot do, and a very limited set of activities that we can do. But the markets seem to have a mind of their own. Just keep rallying, and initially there was this panic in the markets, and everything cliff dived. What was it, 50% in March?
Yeah, I'm not 50%, but I would say what 36, 38% from the highs.
Right,
Yeah,
and since then they've bounced back, and the U.S. markets are almost. I think they're green for the year, right?
yeah.
Kishan?
The Nasdaq has been up for the year, and the S&P 500 is down like what I think 3 or 4% on the tops. Which is like unbelievable. It's just down 3% when unemployment is still down 11%, which is pretty remarkable because in 2008 the market went crazy when this was the when it got so bad with the unemployment uh, figures, but then but then this time around, the situation is like entirely different.
Right.
The markets are just brushing it off. Optimistic that numbers, are this good or this bad.
Right. So I think given the sheer volume of questions regarding this that we've been getting, I think that's why Kishan, you wanted to talk about why the market does what it does,
Yes.
for this episode of Free Float. So take it away, Kishan.
Yeah. Just as you mentioned, I've had friends who have asked me, why the market's moving up. It makes no sense. The markets, um, should be down because there's real economic pain. People are losing jobs. People have to take salary cuts. People would not go buy say a vehicle or a house because you buy those things when you have like economic confidence. Uh, and if you don't know what will happen, say as a person, say 5 10 years from now, you would be like hesitant to spend and you're save, right? And if you're lucky to save, that is. Otherwise, you'd be in a much more dire situation. Um, and this is true in India, and this is true in the US, and like almost everywhere else. Where things might be better than what it was in March, but the pain is still there, and people think it might get worse before it gets better, especially in places like India and stuff where the virus is still forget the crash. It's not even flattened. So I thought it would be do
Right.
um, just in this situation, you know, because um, I mean, it's a good case study for to understand how markets operate. So the first thing is, I think is that the markets are forward looking. They're not doing what is happening right now, or they're not reflecting, or what's the general economic situation right now, but but how things will be say 1 year down the line, you know, and say many years, forward from that. So it is, discounting the present and the immediate future, and I think that, the environment conditions which this virus has created, which is, where central banks and, fiscal policy have become extremely supportive. These policies would continue for a while, and it would, allow, the economy to rebound much more faster, and hence the markets are, reflecting that kind of optimism. Now, there is, there are people who, say that, it is basically only liquidity which is driving it forward, uh, and it's got no basis. It is, like artificial, the markets have been artificially propped up by the Fed in the US, and in India it's, like just because, you've had this distortion because of the liquidity that is, which is also flooded the Indian markets. That's helped, keep it afloat, or to recover from the lows. But
Right.
I'm gonna say
See, the thing
this.
is, what's surprising to me is, as an adult, right, I've been through like 4 or 5 significant crashes, right? So, I was not investing in during the first two, right? So one was the tech crash of 2000.
Yeah.
I just have vague memories of it. Then it was 9/11. It was right at the time, I was applying to grad schools in the US, and I was like, holy cow, now that window is going to slam shut. So I remember those, but those two things, I wasn't really an investor at that point. And after 9/11, it was the 2008 crash, right? And after that, was the taper tantrum, which was another 30% down in the markets, and now we have this. And I can't believe that, so every time, something like this happens, right? The response is more or less the same. So cut rates, right?
Yeah.
The Fed will cut rates, or Indian RBI or whatever are going to. So all central banks cut rates, and then flood the market with liquidity. Make sure that if you're solvent, you're not going to go bankrupt.
Mm.
So this has been like the game plan, since as far back as I can remember. So given that, I don't see how the market is so bullish right now, right? So
Yeah.
if the market truly believed that there's going to be a flood of liquidity and the rates are going to be zero, before the crash, then why did it crash so hard, right?
Yeah.
And then why is so much bullishness? Why is there so much bullishness now, right?
Yeah.
Because it's the same playbook, isn't it?
Right. So what happened this time around is, I think, the central banks were much more proactive. They acted, I think, much before, things really got bad. They acted like in the first week and the third week of March. Most of the policy tools that they had to implement was already out there. The most that they could do was already done by that time. And in that way, I think, say the pandemic response has been, might have been poor, but in terms of the fiscal and the monetary action that these governments took, was much more proactive. And I think what that did is, the way the markets reacted. It's like, the markets are like a warning signal, I think, to central banks and to, things. So, um, they kind of lead, Fed and, and say the fiscal policy, rather than the other way around. Where, they come as a warning, like, the early warning signals, and then that prods, the Fed to act. So, and especially this is more true. It's not about financial. Financial stability. Is the stated goal of the U.S. Federal Reserve. Um, but it is also to do with, say, keeping, enough liquidity flowing, so the system has enough, it's functional, right? So, in the US, you had the the credit markets, like literally froze, especially in the corporate side and stuff. And then you had this unprecedented level of action by the Fed, where they actually went and bought
Right.
debt ETFs, to support the market, and then you
Right.
had them
So
even
that
buying
that actually
junk
pissed
bonds.
off. Yeah, that
Yeah,
actually pissed off quite a few investors because there are a lot of these distressed debt investors in the US who are sitting on a pile of cash, including Warren Buffett and
yeah,
what's that guy, Oak Tree.
yeah,
I forgot the
yeah.
guy's.
I mean, Howard Marks.
Yeah, Howard Marks. So they were all sitting on this piles of cash, waiting. Oh, you know
It,
what? There's going to
this is
be,
the time.
yeah, this is my time. And then before they could, even put their order in, the Fed has come and bought everything in the market.
Yeah,
So
exactly. I mean, I still remember this, that like Airbnb, in the height of the panic and stuff, they raised $1 billion at say about 10% interest or something, all
right.
right? And somebody put out a tweet or something where they should have gone to the Fed. They would have got like better terms. and like I mean, I laughed at it, but I was like, like just stunned that this is actually happening. Like, it's a joke, but it also, like, like I mean, the truth. Like, there's some truth to it, and I was like, and I couldn't get my head around it, that this is actually happening. That there's something like this is actually happening. But I mean, what's happened in the markets in the last few months is very, very interesting. I mean, I think and I think what will this happen is that this will be a template for the future. That today, what you've seen as action is where uh, the markets, have I mean, the economy also, but have been stabilized by proactive action. So before, you would see like a 2 or 3 year period where things would, where a bear market would play out over an extended period of time, and
Right.
and stuff. But now I think the situation has been turned that you have probably a few weeks of like extremely volatile action, and then you have this and then you have the stabilizers that will um, that that come in to support the market.
Yeah, but the
Now,
problem is, see, these sort of stabilizers, as you call them, right? Or emergency action and so on and so forth. I don't see them ever come off, right? So in 2008, they did this whole taper, this whole QE thing. It was followed by QE2, QE3,
yeah,
and then the minute they said, "Oh, we're going to wind down the balance sheet," the markets went into a
yeah,
hissy
yeah.
fit.
Except I mean, say the Federal Reserve went from 300 trillion to say about a trillion and a half or so, like between 2016 to 2019, and where they actually raised interest rates and stuff, right? And what they said was that we need ammunition for when
Right.
the next thing happens, when they started raising interest rates and stuff. And what I found interesting is that as soon as I mean, the things started to turn, they came back, and they dropped things back to the way it was, like 3 or 4 years ago in terms of support. So I completely agree with you that that the situation that we have today is more like a perennial situation, where markets will look like, markets will look to more, not only markets, even governments will look for central banks. Like, now you open the box, right? And so it will be very, very hard for you to enforce some kind of like a market discipline, because if a market likes it, like there's like easy money floating around supporting the economy, and then that finds its way uh, to the markets, which supports it. So it's a very hard uh, pedal to I'm to lift your I'm to lift your leg off. Um, but I mean, there are consequences to this, right? Some of
Right.
it we
I
think,
mean, see, I agree. So on one hand, I agree that this is a net negative, but on the other hand, say you're Microsoft, right? So you're one of the big guys whose bonds the Federal Reserve is buying. So you're effectively at zero yield at this point,
yeah,
right? As Microsoft. So say you want to go borrow $1 billion from the market. So the Fed is more or less going to underwrite it at zero, right? So
Yeah.
you have $1 billion of free cash. So imagine what you can do with it, right? All the fancy stuff that fancy projects that you kept in the back burner, thinking that, oh, this is never going to make any money. So now
Right.
suddenly it becomes feasible, right?
Right.
So all that fantastic ideas like building supercomputers or whatever, right?
Yeah. Except have a counter this to this. Suppose if you could raise money at zero or like even at like negative rates, right? And if you have to build like say a bridge, you know, before when you had to build a bridge and you had to pay interest, at a positive rate, just imagine saying that at a positive rate. I mean, this is so unreal. But then the clock is ticking, right? Because I mean, like every every amount of delay, like is adding up to your cost. So if your project takes like 5 or 6 years more than like anticipated, then you would end up with a much more I mean like a it would shoot over it would shoot past your budget. But if it's like if the thing is that it's if it's yielding negative yield, or if you're or if you're paying extremely low interest rate or at zero, then that incentive for you to of of the productivity of you to keep working,
Right.
that doesn't it's no longer pushed. So there's a lot of like academic study that actually says that that all this money printing and all the liquidity support that we have seen, including the negative yields, actually lead to I mean like like deflation, because people become more slack, like
Right.
and so the productivity growth in the economy is not there, and the more money you print or the more or the more support that you provide, they have diminishing returns. So you did 2.5 trillion today, you know 10 years from now for the next crisis, this would seem I mean it
Right.
would
So
seem
what you're
not at all
saying
enough.
is, we need both the carrot and the stick. So right now we have a lot of carrots, but no stick at zero bound.
Yeah, but the thing is, I don't see it changing because the only thing that I think will change this situation is like inflation, and if you have inflation spike up for some reason, and the reason might be China, because the supply chain and those things are major disruptors that will just push up your prices at the retail store. But if there's no inflation risk or that a market doesn't perceive, then countries and even highly rated corporations would have the ability to to just borrow money at extremely favorable rates without any consequences. So
Yeah, but
I don't think it's changing.
the whole inflation thing, right? So I'm in my mind, there is obviously demand-driven inflation, and there is supply constrained inflation, right?
Yeah.
So those two are not the same. So if the demand for something is going up, and there are bottlenecks in the economy that prevents entrepreneurs to fill that demand, and prices shoot up, those kind of that kind of inflation is sticky. But if you have inflation being driven by supply disruptions, right, those things are easier to solve. So you mentioned, China's supply chain, something going out of whack, and or maybe the onshoring or reshoring, stuff could add to cost. But the problem with that reasoning is that you're only thinking about it as a like as a one time expense that gets carried forward, but that is not true. So even after you reshore it, right, your costs are going to dramatically fall, as you kind of learn, and you improve the processes and so on. So this kind of
Right.
supply driven inflation is temporary. It's just a temporary shock.
Sure. So I mean, those things will happen for sure. I mean, still have better, like better management of the supply chain to, to mitigate this. But I think some effects of it will be for long term. I mean, because it's an unknown, right? So, if you have to move a factory away from China to say, to the US or to Japan or something, right? Um it would just push up I mean the prices of your products that you would pay in say Walmart or like Amazon, for the same items. That would just naturally happen because uh, and these are things that I think which has kept like the American consumer has benefited a lot from this because income in the last 30 years have been flat, I mean, like more or less. But then it's allowed people to have a better standard of living because people have been able to go buy stuff. But um, with if incomes don't rise, or if incomes rise and plus the supply, and plus the and plus and if the price at the shelf, also rises, then you would have that spike in inflation, and you don't need a lot of like inflation to spook the markets. If you just have a greater persistent effect of inflation for even for a few months, it would just change this entire scenario upside down, where you have had so much of debt accumulate like over the world. I mean, America's running at 120% of debt of d- d- debt to GDP. So is Japan is at 220 or 240%. So I mean, all this, and plus it's like, and you have like $17 trillion in like negative yield. So I mean, for that to change, the only thing I see is inflation. Otherwise, this is a thing that will persist for a very long period of time. And I mean, I don't know. So the markets definitely benefit from this, and the sectors that benefit this for most is that it's like a startup, because startups burn does not reduce if someone is sleeping, because you're burning money and your stuff. So that actually explains why startups have high productivity, because because they're not because you're depending on someone else's money for you to grow. You have to work much more harder and stuff. So you don't have the same um, uh, like the same comfort that like a bridge operator would have in say Germany. So it's a very interesting time that that the markets are seem to be in a different universe, but we are trying to explain it in a very rational way of why it's behaving the way it is. And I think we did a I mean we made a sensible argument. I mean, the thing is, we're trying to think very uh, contrary to what most people think, even in the
Right.
market, even with people of years of experience in the market, are dumbfounded of what's happened. So we try to make sense of what the market is thinking and stuff. Uh, what the consensus is really is, who knows? If everyone is just now, like trying to get on the same bandwagon as the market, right now, because like people have to show the performance and stuff. So right now it is a very uncertain market, but most people are dumbfounded, but still are trying to keep up.
Right, right. Well, I hope it doesn't like, go crashing back to, to where it was before, because we've seen this happen during bear markets as well, right? Sudden reversals. So this
Yeah.
happened in 2008 as well. So for a minute, everything kind of rose back up,
Then,
and then, the second leg down. So hope the Feds and the other central banks are continue to do whatever they're doing, and hopefully we'll have a vaccine soon. So there's been a huge amount of news flow on that side of things as well. So hopefully that'll keep the optimism going, and the rally in equities going as well. All right, guys, thank you for tuning into Free Float. I hope you find our discussion and what we've written useful in navigating today's markets. We will see you again next week. Bye.
bye.